It is a slow day for the markets as we start things off with a holiday for the bond market in the US. And so liquidity is kind of thin. Nevertheless, stocks power higher. And in the futures markets, bonds inch down again. But the big story may be elsewhere entirely. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we are going to focus on here is going to be the outlook for the financial markets in the week ahead and what macro catalysts are going to be important to watch. And the story takes us out of equities, out perhaps even the bond market, and out of perhaps even commodities, and points us squarely at currencies. We'll start, of course, with a look at where things were relative to last week, what the markets did, and how we got here, and then take a look at what comes next. Here's how the markets performed last week. We can see a bit of a passing of the baton here from what happened in the bond market in the prior week to now a little bit more life on the stocks side. So the S&P 500 and NASDAQ managing about a percentage point of a rise apiece. That's, of course, much better than the essential standstill in the previous week. At least some of that renewed vigor almost certainly comes from a little bit of a cooling from interest rates. We can see that at the front end of the curve, we only saw a 0.9% rise for the 2-year rate. That's after the scorching 10.2% rise in the prior week. So a significant slowdown at the front end here. The long end, though, continues to march higher, albeit at a slower clip, 5.7% rise in the 10-year rate a week from last week. And then last week, the slower 3.4%. So a little bit of a more measured move, but nevertheless, a steepening of the yield curve, which now comes in at 13.7 basis points in the spread between the 10 and 2-year. That's just a hair from the 2.5-year high at 19.1 basis points recorded in late September, all of which seems to speak to this reflation idea that we have the Fed marching down the path of stimulus. And of course, there's quibbling about how much stimulus and how fast it's going to come and when. But the overall story, seemingly since September, has been of a yield curve that is steepening because the long end sees rising rates on the expectation that the Fed is doing this easing. Meanwhile, the U.S. economy is actually heating up. U.S. economic data has increasingly improved relative to forecasts, as we've been watching here for about a week and a half now. And the bottom, now looking back, seems to have been around late August, early September, where the economy seemed to shift into a more supportive gear. And that's last week's disappointing jobless claims numbers notwithstanding. We've of course seen very strong numbers on service sector growth from ISM, a very strong jobs report, a CPI report last week that was a bit hotter. And the markets seemingly took all of that to say this is an economy growing at a decent clip now with the benefit of cheaper money in the front end, hence that 10.2% jump last week, and of course the shift elsewhere in the preceding several weeks. And what that's going to mean is it'll mean higher yields downwind. It'll mean that rate cuts can't go as far. It'll mean that rates will be higher later, and that's because all of this is going to be reflationary. Now, we've seen that this upshift in yields has started to have some negative effect on other assets outside of the usual suspects, but gold has held up incredibly well despite rising yields. We can see last week it was flat and even a little bit higher, which frankly is incredibly strong performance considering how fast yields have been going up, that it's been able to hold up. The US dollar, though, has benefited. Another week of strength for it, 0.3% down in the euro, 0.3% down in the yen. Bitcoin manages a tiny uptick after a 5.2% decline, but the greenback still holding very strong. That, of course, speaks all the more to gold's resilience, that it's been able to hold up largely in the face of a stronger dollar and stronger yields, which is unusual. And all of that seemingly telling us a story here whereby the geopolitical angle starts to enter into the picture. And with that in mind, we, of course, have to look at what's going on in crude oil. So looking at last week's rise, we can see a much more modest 1.6% increase after a 9% plus surge. That seems to suggest that perhaps geopolitical considerations were already slowing as an influence for crude oil. The conversation, of course, has been about the possibility of escalating conflict between Israel and Iran in a more direct fashion, and Israel's eventual retaliation against the latest missile strike from Iran directly on Israeli soil. That has kept seemingly both oil up and gold insulated from larger dynamics. But of course, even as we speak here now, we've heard headlines come across the wire suggesting that the Israeli response will be limited to military targets, not crude oil, not nuclear infrastructure, and gold and oil are now significantly lower, even just intraday. So these are things in motion now. But last week, we already saw lingering concerns, perhaps, hence gold's resilience and crude oil's uptick. But the modesty of crude oil's uptick seems to suggest that those concerns were already easing. And this is what we face in the week ahead. A bit of a shuffle from stocks to bonds, a bit of a shuffle around geopolitics in commodities, at least the headline commodities. But the steady story that has continued, regardless, seemingly, of all of these considerations, is US dollar strength. In fact, the greenback here is really putting on something of an impressive showing. So if we consider what we've seen at this point so far, the dollar is now working on the third consecutive week of gains after a blistering rally at the end of September, and then a bit of extension last week, such that if we look at the way that the dollar has performed against a range of its major counterparts, and we'll discount this week because, of course, it isn't over yet. We'll see how things go. The dollar has now enjoyed, as of the end of last week, the best 2-week run that it has seen in, just about 6 months. We'd have to go back to April, middle of April or so, to get anything comparable to the past 2 weeks of US dollar momentum. And all of this seems part and parcel of the conversation that we are having vis-a-vis reflation. If we are going to have higher rates and less scope for easing in the US, that compares favorably with what might be occurring elsewhere and increases the potential for the US dollar to maintain a yield advantage against other currencies and even to expand that yield advantage. It is with that lens that we look at this week's news flow, which tends to have its highlights outside of US economic data. And the first key point here, UK CPI. The headline here expected to dip to 1.9%. That would be the lowest that we've seen since April of 2021 and cautiously under the 2% target. Of course, 1 month does not a trend make, and central banks aim for medium-term inflation expectations and inflation objectives, so that we've crossed the 2% mark 1 month doesn't necessarily change the game in a dramatic way. But we do see that UK economic data has been tending most recently to underperform relative to expectations. And what we find here then is an interesting situation, because if we consider where the lingering inflation in the UK lives, so which areas here still are the most significant for holding up inflation, we can see these big bars here amounting to significant uplifts, at least looking back at August, are restaurants and hotels, so hospitality, and recreation. Both of them discretionary spending areas. So if the economy is in fact cooling relative to expectations, and we can see in that this has turned negative on the surprise index, that UK economic data has now started to disappoint on balance relative to forecasts, well, then we have the kind of economic slowdown that might inspire the Bank of England to say, well, if inflation is in cyclically sensitive areas and the cycle is turning down, well, then this move down in inflation that we see right here, that's probably durable. And if it's durable, that might give us more scope to cut rates. Now, as it stands, we're baked in for about 31 basis points in cuts through the end of this year. So at least one cut at the upcoming 2 meetings, November and December, is baked in. The cumulative probability of a second cut is obviously not 100%. It's at about 61%, but that, of course, makes it likelier than not that we get a cut at each one of these meetings. It also creates some room for certainty to get baked in before we even look at next year's expectations. So if we went, for example, from 61% likelihood for 50 basis points to, let's say, 70, 80, 90, then that, of course, would be a policy adjustment in its own right, or at least a policy outlook adjustment from the markets. All of which sets up an interesting situation, because if in fact data is now underperforming relative to forecasts and we get a softer number here, then it's the British pound that's in the line of fire, just as it is sitting at this critical support right around the 130 level. Obviously, we can see the dollar has already made important inroads here, but if we get a break of this, then 129 and perhaps 128 here are not far away, opening up a significant pocket here of further British pound weakness. Then we turn to the European Central Bank, where we have a monetary policy announcement. They're expected very narrowly to cut interest rates. We can see here it's about a 50-50 shot here, but slightly biased in the direction of the cut, about 52% chance that we're going to have the cut. But we can see that by December, that cut is already priced in. So as with the UK, at least one cut is on the board here. and we're leaning towards 2. So we can see here, we're not quite 50 basis points lower here versus here, but almost. And what this amounts to in aggregate is an 86% chance that we're going to get the 2 cuts. So 43 basis points of the 50 are baked in. Now, if we look at the way that this policy path has evolved, it's somewhat anchored a little bit. So we're leaning in the direction of the 50, and then about another 100 basis points, 92 of which to be precise, are already baked in for next year. But the overall path hasn't really moved very much. There was a little bit of overshoot in September around the consternation in global markets that saw dovish expectations build basically everywhere as markets gyrated. But we've basically anchored back here right around the same levels that prevailed coming out of the mid-year and into the third quarter. So the key question here now becomes, what does the ECB do and how do they adjust this calculus? Now, whether they do the cut or not is itself market moving because it isn't fully baked in, as we just saw. So if they opt for the cut, that is a market moving sort of consideration. And of course, if they then dial up dovish rhetoric, that also moves the needle and perhaps gets this cumulative tally out to a more dovish setting, which would make sense considering that leading PMI data suggested that in September the economy shrank again unexpectedly. In other words, all of the rebound from the late 2023 shallow recession has now been erased and we're shrinking once more, which seems to give the ECB what it needs to press on with stimulus. Looking at the situation in the euro, we've already come a long way as this dovish rethinking of expectations has already started to take shape as the economic data has soured. But now we have the possibility, if we get through the 109 figure, to open the way down to 108, which is a relatively interesting inflection point here. And then from there to 107, which would bring us back essentially to June, July lows. So not even that much of a stretch relative to the euro's recent history. So again, we are looking for another pocket of US dollar strength here if the ECB starts to speak with a more dovish voice given this recent economic data. And then finally, China. Wrapping up the week is the third quarter GDP number. It is expected to see the second consecutive quarter of deceleration from 4.7 down to 4.5% year on year. That would follow already disappointing numbers out of China earlier this week. We saw that the trade numbers disappointed. We saw that inflation numbers disappointed. And of course, China's fiscal stimulus press conference with the Ministry of Finance, that disappointed too. Everybody was looking for China to actually start to create some government finance demand because the economy has been effectively stuck in deflation for 5 consecutive quarters. It looks like it might be 6 because the stimulus on offer here was not demand creating. Rather, the Ministry of Finance came out and essentially said that authorities are going to buy up some idle land, buy up some unused commercial property, and use a bunch of money at the federal budget level, borrowed federally, to give to the regions, to give to local and municipal governments to cover outstanding debts. So shuffling papers, as it were, from column A to column B, all of which basically just creates more inducement to economic activity, giving regions more room to borrow new money to spend, giving the housing market a boost, and maybe encouraging investors to say, oh, the situation here need not be a precipitous decline and we can start to lay out money again. none of it is demand creation. And if the GDP number misses, then that would essentially extend the malaise. We of course also see that the surprise index for China remains in the doldrums, data still very much tending to underperform relative to expectations. Now, China has done a lot to mandate its markets higher, essentially by decree on mainland, but the inability for China proxy assets to follow has been very telling, and the Aussie dollar is important amongst these. It's sitting at support basically at the 67 figure now, and if it breaks, then into the low 66s and perhaps through the 66 level opens up. So if we get a GDP number that disappoints and extends this pessimism, especially after this stimulus announcement falls short, well, then we end up with still more dollar strength in yet another pocket of the currency markets. And that is macro money for today. We will, of course, build on all of this as the week progresses and we take these events one by one in greater and more granular detail. We're here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. On Wednesdays, I'm on with Victor Jones for the Price of Truth. On Fridays, back with Chris for Futures Power Hour. On Sundays, with Victor and Tom for First Call. Writing for the News and Insights portion of tastylive.com and commenting on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.